In March 2023, a bank with $209 billion in assets collapsed in 48 hours. Not decades, not years, 48 hours. Silicon Valley Bank, one of the most prestigious financial institutions in American tech, evaporated over a long weekend. Customers lost access to payroll funds. Startups couldn't pay their employees. Founders were refreshing their banking apps at 2 a.m., watching balances freeze. And here is the part that should make you sit up. The bank wasn't robbed. There was no fraud, no criminal conspiracy, no rogue trader making insane bets with customer money. It followed the rules. It did what banks do, and it died anyway. Meanwhile, J.P. Morgan Chase, a bank that nearly collapsed in 2008, survived that crisis, survived SVB's collapse, and today sits on $3.9 trillion in assets, bigger than ever. So the question isn't just what killed Silicon Valley Bank. The question is, what does J.P. Morgan know that SVB didn't? What separates a bank that buries itself from a bank that buries its competition? Because the answer isn't luck, and it isn't talent. It's a set of mechanisms so deeply embedded in the financial system that most people, including most bankers, never think about them consciously until something breaks. That's what this video is about. Here's something worth knowing before we go further. Right now, across the United States and Europe, regional banks are under quiet pressure. Commercial real estate loans are souring. Interest rates stayed high longer than anyone planned. And a handful of mid-sized banks are carrying bond portfolios that, on paper, look fine, but in reality are sitting on losses they haven't officially admitted yet. The FDIC, the agency that insures your deposits, currently lists over 60 banks on its problem bank list. That list isn't published publicly, by the way. You can't look up whether your bank is on it. That's not conspiracy, that's policy. Because the moment people know their bank might be in trouble, it accelerates the very collapse the regulator is trying to prevent. So we're going to pull back the curtain on how this whole system actually works. Not the glossy version, the real one, the one with the uncomfortable math baked in. By the end of this video, you'll understand why some banks are structurally designed to survive almost anything, and why others, despite looking completely healthy on a Tuesday, can be gone by Friday. Let's start at the beginning. Most people think a bank is a place where money is stored, like a vault with customer service. That's not what a bank is. A bank is a machine that borrows money short-term and lends it out long-term. Read that again, because it's the entire game. You deposit $10,000 into a savings account. The bank now owes you that money. You could ask for it tomorrow. That's a short-term liability for the bank. The bank then takes a large portion of that money and loans it to someone buying a house. That mortgage gets paid back over 30 years. That's a long-term asset for the bank. So the bank has borrowed short and lent long. It makes money on the gap, that spread. That gap is basically the entire business model of banking. Simple, right? Almost elegant. Except there's a structural problem buried inside it. A problem so fundamental that economists have a name for it. They call it maturity mismatch. Your savings account is callable at any time. The mortgage isn't. The bank can't call back a 30-year loan just because depositors want their money. So if too many people ask for it at once, the bank physically cannot pay them, not because it's broke in the traditional sense, but because its assets are locked up long-term, while its liabilities are short-term. This is the original sin of banking, and every single bank in the world lives with it every single day. The only question is, how well have they managed it? Now here's where it gets interesting. Banks don't just lend out your deposit once, they lend it out multiple times. This is called fractional reserve banking, and it works like this. You deposit $1,000. Under most modern reserve requirements, the bank keeps a fraction, say 10%, on hand. It lends out $900 to someone else. That person deposits the $900 at another bank. That bank keeps $90, lends out $810, and so on. By the time this chain plays out, your original $1,000 has effectively become $10,000 in the economy. Money has been created, not physically printed, but created through the lending process. This is legal. This is intentional. This is how central banks manage the money supply. And this is also why a bank run is so catastrophically dangerous. If even a modest percentage of depositors ask for their money at the same time, the math breaks. There isn't enough cash. There was never meant to be enough cash. The whole system is premised on the assumption that most people won't ask at once. In normal times, they don't. Humans are creatures of habit and inertia. You leave your money in the bank because it's inconvenient to move it, and you trust that it's there. That trust is the actual product, not the vault, not the building, the trust. Which means the moment trust wobbles, even slightly, the entire architecture is at risk. SVB's depositors saw one tweet, then another, then a Sequoia Capital memo recommending portfolio companies withdraw funds. Within hours, $42 billion in withdrawals had been requested in a single day, the equivalent of roughly half the bank's deposit base trying to leave through a door that was never built wide enough for more than a trickle. It wasn't a crime, it was a geometry problem, and SVB didn't have the geometry to survive it. So how do the giants survive? How does a JP Morgan, a Bank of America, an HSBC weather crisis after crisis while smaller banks get vaporized? There are three mechanisms, and they work together. The first is diversification, not of investments, but of depositors. SVB had a very specific problem. Its deposit base was highly concentrated. Venture-backed startups, tech companies, a relatively small, interconnected community that communicated constantly on Slack, on group chats, on Twitter. When one sophisticated investor said, "Move your money," that message reached thousands of CFOs within hours. JP Morgan has 80 million retail customers, pensioners in Ohio, small businesses in Georgia, college students with $400 in checking. These people don't have group chats with Peter Thiel. They don't get memos from venture capitalists. They don't move in herds. The boring depositor is the stable depositor. The sophisticated depositor is the dangerous one. That's a deeply counterintuitive lesson. The prestige clients, the ones banks fight over, the ones that bring in huge balances, can be your structural vulnerability. The second mechanism is what's called the deposit franchise. This sounds academic. It isn't. A deposit franchise is the ability of a bank to attract sticky, low-cost deposits over time, usually because it has a huge branch network, strong brand recognition, or services that customers don't want to leave: checking accounts, direct deposit relationships, payroll processing, business accounts. When you have someone's direct deposit, you have their financial life. They don't leave. It's too much friction, too many linked accounts, too many automatic payments to reconfigure. You've achieved a kind of financial gravity. JP Morgan's cost of deposits, what it pays to borrow from customers, is famously low compared to smaller banks because it doesn't need to offer you a great interest rate. You're already there. You're not leaving. And when interest rates spike and smaller banks have to pay customers 5% to keep their deposits from fleeing to money market funds, JP Morgan can offer 0.5% and still retain most of its base. That is an enormous structural compounding advantage that never appears in any headline. And the third mechanism is access to the lender of last resort. This is perhaps the most important one and the least discussed. When a bank is in trouble, when depositors are demanding cash faster than the bank can liquidate assets, it has an option that most people don't even know exists. It can borrow from the Federal Reserve directly, overnight, at a predetermined interest rate, using its assets as collateral. This facility is called the discount window. It's been around since 1913, and it exists precisely because of the maturity mismatch problem we talked about earlier. The Fed knows that a fundamentally solvent bank can be killed by a liquidity crisis, a bank run, even if its underlying assets are fine. So it offers a lifeline. Here is the catch.
Using the discount window carries stigma. The moment a bank borrows from the Fed, the market whispers. Analysts notice. Other banks start reassessing counterparty risk. The act of reaching for the safety net itself can trigger the fear it was designed to prevent. So in practice, only the largest, most established banks use it comfortably. They have the relationships.
This is the part of the story nobody tells in the press releases. Size isn't just about market share. Size is access. Size is options. Size is the phone call that doesn't have to be made publicly. Let's talk about the number that almost nobody discusses. In the United States, the FDIC insures bank deposits up to $250,000 per account per institution. The FDIC's Deposit Insurance Fund currently holds approximately $121 billion. Total insured deposits in the American banking system, roughly $10 trillion. Do the math. That's about 1.2 cents of insurance for every dollar of insured deposits. Now, that's not necessarily a crisis. The FDIC also has a line of credit with the Treasury and can borrow essentially unlimited funds in an emergency. The number isn't meant to cover everything simultaneously. It's meant to cover one or two banks failing at a time. But here's the quiet truth. The insurance fund is backstopped by the government, by the taxpayer, by the implicit promise that in a systemic crisis, the federal government will step in and make depositors whole, regardless of the technical limit. We know this because we've seen it in 2008. In 2023, when SVB collapsed, the Biden administration guaranteed all deposits at SVB and Signature Bank, including amounts well above the $250,000 insured limit within 72 hours. The official line was, "This is not a bailout." The functional reality was the government guaranteed private deposits at failed banks using public credibility and the implicit backing of the U.S. Treasury. You can decide for yourself what word fits that. The point is, the system has a silent underwriter, and that underwriter is you. Here's something the financial services industry does very well. It projects certainty. Walk into any major bank branch. The marble floors, the conservative suits, the weight of the furniture, the language of solidity and permanence. Your money is safe here. And for most people, most of the time, it is. The odds of your specific bank failing and your specific deposit being at risk on any given day are genuinely very low. But the architecture of that safety is not what they're implying. It's not the marble. It's not the capital ratios on the annual report. It's not the risk management committee meeting quarterly to review stress tests. The architecture of safety is the network of implicit and explicit government guarantees layered beneath the entire system. The deposit insurance, the discount window, the too big to fail designation that forces regulators to protect the largest institutions at all costs because their failure would be catastrophic for everyone else. In other words, the banks that survive everything do so partly because the system cannot afford to let them fail. Not because they're brilliant, not because they're virtuous, because they're load-bearing. JP Morgan is too big to fail. That's not an insult. It's a structural fact with legal and political implications. It means JP Morgan can take risks that smaller banks cannot because the market knows implicitly, with no paperwork, that the government will intervene if things go badly enough. Smaller banks don't have that cushion. They have to be actually safe, not just too big to be allowed to fail. And that asymmetry between institutions protected by their size versus institutions that have to survive on their own merits is one of the most consequential and least discussed structural features of modern finance. Zoom out for a moment. This system, fractional reserve banking, maturity mismatch, deposit insurance, lenders of last resort, and implicit too-big-to-fail guarantees has been the global financial architecture for roughly a century. It has produced extraordinary economic growth, unprecedented access to credit, the ability for ordinary people to buy homes, and for small businesses to expand. It has also produced a financial crisis roughly 10 to 15 years, each one different in its specifics, each one identical in its underlying logic, a system premised on confidence, hitting a moment where confidence wobbles and the structural fragility underneath revealing itself. And each time, the solution has been largely the same: more government backstops, more implicit guarantees, larger bailouts, bigger safety nets, which has the effect, the perhaps unavoidable, perhaps intentional effect, of making the system slightly more fragile next time. Because if you know you'll be caught, you take bigger risks. Economists call this moral hazard. The rest of us might just call it human nature. The banks that survive across generations aren't just smart. They're embedded. They're structural. They've made themselves so central to the economy that their failure becomes everyone's problem, which means everyone, including governments, will work to prevent it. That's not a conspiracy. That's not even a critique necessarily. It's just the honest description of how the system actually works. Here's where I'll leave you. The banks that survive everything, JP Morgan, HSBC, Deutsche Bank, have survived not just because they're well run, they've survived because they're entangled to be allowed to die. Their survival has been, at various points, actively subsidized by governments using public money and public credibility. At the same time, the small and mid-sized banks that collapse, SVB, Washington Mutual, IndyMac, Lehman Brothers, they have to face the actual music. Their shareholders wiped out, their executives disgraced, their employees scrambling. And depositors at those banks, often ordinary people in businesses, get caught in the chaos, sometimes for days or weeks before the government steps in. So here is the question I want you to sit with. If the largest banks benefit from an implicit guarantee that smaller banks don't, if size itself is a form of protection that the market has already priced in, then what exactly are we calling a free market? The banks survive because the system needs them to. Not all of them, not the smaller ones, just the ones that have become, over time, too central, too connected, too politically significant to be allowed to collapse. And the rest? The rest are on their own, just like you.